So I think it's going to be much worse than you saw in 2008. It's going to be a prolonged crisis, first with a 2008 kind of scenario where you had a deflationary bust. Then you'll see the Fed and everybody else in the world, central banks, geniuses around the world, will try to do the trick again with the QE kind of thing or whatever, similar kind of thing. And then you're going to see a stagflation set off. And that's why it's going to be much more prolonged and a much more severe crisis in terms for the consumers. So helping a few banks, merging them up and all that, yeah, they will do a lot of that. Will it solve the crisis? No, it will not.
On this episode of the WTFinance podcast, I have the pleasure of welcoming back Henrik Zeberg, who's a macroeconomist, founder, and publisher of the Zeberg Report. So, Henrik, thanks so much for coming back on the podcast today.
Thank you very much for having me on.
No problem. Looking for the conversation. And I was just saying before that we sort of spoke at the start of the year and you had some quite bold predictions, which I think, everyone's always surprised by them. But to be honest, you've been pretty right so far. Markets have continued to go up. And then you said there's sort of at some point this year, you think there could sort of be a reversal. So, can you maybe just go over what your current thoughts are, if they've changed since we last spoke in January? And we can go from there.
Sure, but I think we are exactly seeing what I think we spoke of the last time, that we have an ongoing blow off top, which people say, well, where is the blow off top? But they should actually look at some of the percentages of how much the market has actually been moving up. You have a crypto market also that is starting to roar. You've seen Bitcoin moving up quite a lot. So we have all the components of this. The bull market that is continuing for now, and that I also expect to continue for some time still. But the difference is, not a difference from what I said earlier on, but the difference from me and others, so that is that probably that I say that this has an end date, and that end date is this year, and the end date will probably be in, say, September for the markets, and in Q4 for the economy, which means that the recession is probably going to set in Q4. So this is what I see, and the indicators are just becoming more and more visible now in terms of the economy rolling over, and it surprises me to see that people really do not understand what's going on. But then it's good that you and I can have a chat about it.
Exactly. They can listen to us and hopefully find out why. And I know last time we spoke, you sort of thought that you would see a peak in April. So I guess from your perspective, what has changed that outlook?
Sure. So correct, and that is correct also. And then people will probably say, well, then you're wrong. But the thing is really that it's taking a little longer than I expected. The reason is the labor market has been extremely strong, and everything is about the economy here. It's about how fast will you see that the spike in interest rate is going to wear out the consumers, so that you see that the real economy rolls into a recession, and as we get closer and closer to that, you'll see the market peaks out. So to me, it's not about being right. When you and I talked in March, or earlier this year, actually it was in January, I think, but it's not so much about pointing out the specific time slot. It's about being on the right side of the market, and I've been long, and extremely long. I'm the most, and still am, in risk on assets for a long time, and probably people know that I'm in Jasmy also, and in Bitcoin miners that I also expect to a lot of into the coming weeks and months here. So I'm quite okay with that. The market is moving up still, but the thing is that the economy is deteriorating, and it did not deteriorate as fast as I saw it, let's say a year ago, and that's the way it is sometimes, but it is absolutely deteriorating, and we start to see signals that you only see before a recession now starting to flash. So you have 3 or 4 of those that have never been wrong, and they have all flashed now. And you also, when you have analysts talking about the soft landing, where is the soft landing when the interest rates are at the levels that we see right now? So people are confusing with what they see in the market, which is more driven by FOMO, and also liquidity, when that starts to come in now again, also with the dollar that starts to decline now, and interest rates coming down, and the Fed maybe start to talk about rate cuts at some point. Well, these are things that will influence the financial market for a certain amount of time until until the recession sets in, and this is what we're going to see. So yeah, I feel comfortable being, first of all, long at this point here, and I see a lot of upside still. As you know, my S&P target is still 6,100 to 6,200, which is also was in January, and I see that the economy is slowly rolling over, and the last phase of that is where you will have the blow off top. You will have everybody, rotating into more and more riskier assets just into the top of the market, and that's quite unfortunate, but that's how I see it.
Yeah, and as we know, it's very hard to predict timing of things, as large as the economy and markets and other aspects. Do you see the risk being potential? And as you said, it's not going to affect you because you're long, but this could sort of maybe be prolonged even further into early next year. Do you think that's possible?
Yeah, and then people will again say, yeah, because now you didn't see that in that it could go, on from, let's say, April or May until September, and they'll say, well, the markets or the economy can deteriorate for a certain amount of time, and the more indicators you get that now we're getting closer, could I see it move all the way into Q1 of 25? Well, I would say no now, right now, because I think things are just teetering right now in terms of, starting to see the decline in rates. But yeah, of course, it could move into Q5, Q1 of 25. It just doesn't look like it. It absolutely just doesn't look like we have this much time to go on with it. So we know that the Fed will try to counter this, and they will start to talk about rate cuts, and people think, oh, they're going to save the day again, just like they did before the financial crisis and before the 2001 dot-com crisis and so on. But they will not. They cannot, because when things are really starting to turn, it's really turning. And what we see now is that if you look at some of the numbers that tells us something about unemployment, well, the unemployment rate and the number of unemployed people are now crossing the lines for where it's, the line has been crossed, so that there's only one, solution to it, and that is that the economy is slowly falling into a recession. So how fast? I think Q4. Could I see Q1? I have to say yes, but I think it will be Q4.
Okay, makes sense. Yeah, as you said, it's you don't want to close any options off because everything's always possible. But do you? So I think can you remind us maybe, for people who haven't listened to our last interview, because I know you've mentioned this before, what are the key indicators that you're watching? Because I know you have sort of Zeberg indicator that you'll pay attention to sort of put your positions on.
Sure. So the way I look at the economy is through the lenses of the business cycle, and the business cycle are defined by leading indicators, coincident indicators, and lagging indicators. Leading indicators are the ones telling us where the economy is heading, and those are the ones like so. Housing permits and so on, the things that will tell us something about when the economy is starting to get started again, because interest rates has been declining for a certain amount of time. But then you start to see the number of housing permits coming up, and similar indicators like that, you will start to see that actually the economy will start to improve. And then you'll have the coincident indicators, which are more of the real economy. You can say the labor market. Those are the the unemployment rate and those kind of numbers. And when they start to, when the economy starts to get going, you'll see that they come up slowly as the economy strengthens, because people are starting to believe in the economy again. And then you have the lagging indicators, which are the rates, the market yields, and you'll see that they will slowly start to rise as the economy gets going. But when the party is then getting too, you know, it's just the party's getting started and everybody is thinking, oh, now this economy is just going to continue to expand forever, then you'll see the yields coming up, market rates coming up. And this is the cycle, the business cycle, and that is what we've seen this time around. Again, we see now that that is starting to hurt the consumers, and that's why we have a recession signal on the leading indicators, and we now need to see those leading indicators actually falling, leading the coincident indicators, which are the unemployment rate. So I expect the next things we're going to see is that unemployment rate is starting to come up slowly, and the initial claims, so people reporting in as unemployed will also start to come up, and we have the first signs of that. But the thing is, we have the largest stimulus that we have seen ever coming out of the corona crisis, which means that there were a lot of fiscal and monetary stimulus pumped into the economies, and that created an artificial situation of a lot of demand. And a lot of companies were scaling up capacity wise and so on. And what has happened is that they have now expected that demand to stay. But guess what? Stimulus is there for a certain amount of time, and then it needs to be, the cycle needs to go by itself. But it was a overstimulated economy at that point. That's why it was running hot, and that's why we got the inflation rate of that high. So now we see companies a little reluctant to actually cut the capacities, but it will happen eventually, and I think it's starting very soon. Actually, we didn't see the corporate profits that we saw, earnings levels we saw last week were not good. So in my book, that tells me that we are getting closer to the point where companies will have to lay off people, and then we get into the next phase of the coincident indicators where we have the real rollover and we have the economy falling into a recession. So we got another 6 months, I think, before that happens in the economy. Will not be felt in December. Let me just say this: is when we stand right in it. It's not there where the economists will say, "Oh, this is now this is the beginning of the recession." It never happens like that. It always happens in a way where some people will be able to see it, and then you'll see that the various analysts will start to pick up on this when as the economy and the markets are starting to decline, and people start to say, "Oh, something is wrong here." And sometimes you'll actually see that the actual recession call from the NBER comes, up to a year later. So please remember that when we stand in December, nobody rings the bell at the top of the market, which may be in Q3, but nobody rings the bell also on the economy in Q4. So we have to investigate. We'll have to analyze ourselves and understand where we are.
Yeah, so you don't see, because if I look at it, sort of what you're saying, it sort of reminds me a little bit of, and maybe this is further on the cycle, but the end of 2022, where companies were missing earnings, there was concerns this was going to happen, and then sort of they cut headcount, there were these small changes, and then they were sort of able to rebound after that. But you think that all the COVID stimulus has run out for the consumer, so we're not going to see something similar to that?
Absolutely not. I mean, we are a completely different place than we were in 2022. So after actually there was a recession signal into the corona crisis also, and I've shown on one of my shows that you can actually see how you could predict the corona crisis and the crash in the economy. It did not just come out of nowhere. You could actually tell by three certain signs in the economy, and one of those were that we saw the interest rates coming down really strongly after we had a recession signals in some of in the indicators that I follow. And we also saw some weakness in the stock market. So you could actually have called that. But what they did was, to stimulate the economy in an extreme way. And when we got to 22, what we saw there was the slowdown because of the inflation spike. It was nothing to do with the business cycle was not crashing at that point at all. Actually, you had the crossover of the leading indicators first in early 23. So when people were calling for a crash in 22, I said, well, no, you're not going to have a recession at this point here. So it was a completely different situation we had back then. You were in a situation where the economy was actually booming from all of the stimulus money coming out. Yes, you did have a correction in the market. It was a very deep one because of the inflation, but it was not a recession at all, and it has never, been recognized as a recession. Rightly so. So it was a market correction in a bull market, and the recession is something quite different. And this time around, we are coming to the end of the road at this point. I don't think people really realize where we stand here. I mean, I was just this morning looking at some of the key ETFs that I follow, also in terms of the XLF, which is the financial sector, U.S. financial sector. And to me, we are coming to a major top in that, and which means that if I'm right, you're going to see something similar to what we saw during the financial crisis. And a lot of people do not remember what happened during the financial crisis, but it is a completely different situation than what we have seen over the last 16 years. So that is the kind of scenario what we need to look into. We need to look into a liquidity crisis where banks are collapsing. We're credit crisis and financial crisis. So this is going to be really, really bad, and we're going to see markets decline to much lower levels that we have today. We have the largest bubble ever. So how people are saying, oh, but why would it? And I can't see and blah blah. I mean, well, just look at it. Look at the market valuations. Look at the distortion of money. Look at crypto. I mean, why are so many people engaging in crypto, myself included, into something which is clearly a bubble? Um, I say that without blinking. I'm part of it right now because if you're not, you're probably a little stupid here because it's going to do fantastically well into the last part of this phase, but it's still a bubble, and that bubble will collapse when the recession sets in and liquidity crisis sets in. So I think people will really understand this, when we get a year down the road. But for now, people will say, yeah, but markets are going up strongly, and Henrik probably he'll probably not be right this time around. Let's see. I think I'll be right.
Do you think it's possible to have something similar to 2008? I guess if we look at what we saw last year with the banking crisis, the Fed and sort of other government entities, they worked overtime to try and prevent this fallout. We look at Credit Suisse, combined with UBS over one weekend, and that sort of resolved similar with some regional banks in the US where they combined with JP Morgan and other companies. Do you see something similar where it might be a far more aggressive and sharp drawdown potentially versus the recession, and then the government will do what it can to sort of resolve it, and then we'll see further upside? Or do you think it could be similar to what we saw in 2008, where it's years?
It's like 2008 this time around. I mean, people think that this is just about the financial sector and it can just be, solved by, putting two bad banks together and then say, now we have two minuses, gives a plus here. It doesn't really work like that. So I don't believe, and yeah, let me say this also, and also the very idea that it's all about the financial sector is so naive. It's not just about the financial sector. This is about real people who have a house, has a job today, who are going to lose their house and who's going to lose their job. And these people, we are then saying, oh, you know what, Mrs. Johnson, you're going to be fine because UBS and Credit Suisse, they'll be, they have been merged, but whichever bank it's going to be, it's all going to be fine. So you don't worry. That's not how it works. And this is so misconstructed and misunderstood. Yes, we're going to see a lot of that because they will need to, because there will be a lot of banks failing. And the reason that they are failing is because Mr. and Mrs. Jensen here in Denmark will not be in a good state. So they will need to make sure that the banks do not collapse. And they will also need to do it because a lot of people have been using money, investing money into crap investments. So what happens when you start, as we did in 2008, on a journey of money printing, is that you are distorting money. You're distorting the allocation of money into society. So what happens is that you will, when the interest rates are dropping to zero, everybody with money on their hands will say, oh, you know what? If I can get 0% in interest somewhere, why, or 1% if I'm lucky, I will go to try to find that, unicorn somewhere. And everybody goes searching for that and they put money into, all sorts of businesses. But guess what? A lot of these businesses, they have shitty business cases or business models, and still they have been pumped money into them, but a lot of these money are going to be lost. So private equity sector is going to suffer this time. There will be a lot of commercial real estate also that will suffer, and so on and so forth. There will be so many places where we're going to see this is going to spread to. So this is not about the financial sector. Last time the financial sector was a big thing, and we saw that, but it's really also to understand the customer. The customer, 70% of the GDP is the customer, is the consumption in the US. And if the customer is suffering, and they will for some time because of the interest rates and the inflation levels, well, then you're going to see a recession. So they cannot just, shortcut the recession. And if they try to stimulate the way that they did, after Corona, well, remember what we saw. We saw inflation coming up like that. If we do that one more time, I can tell you inflation is going to be a lot higher than that. And I think they're going to do that. I think they're going to try that because that's the free lunch. It worked in 2008. So why don't we try it again? I just think that this time around will be different because if you got burned by high inflation rate and high interest rates, you will probably think this time around, even when you start to see a little more free money in your, private pockets and your pockets, you'll think, well, maybe I should save this money. Maybe I shouldn't just go out and buy a new washing machine or a new car, whatever. And then that is where QE stops because if people do not spend the money and it doesn't set that consumption wave in motion, well, then the money will just stand on the banks, and then it will start to circulate into more um, speculative things. And that's why I think we're going to have potentially also a stagflation later on. So I think it's going to be much worse than you saw in 2008. It's going to be a prolonged crisis, first with a 2008 kind of scenario where you had a deflationary bust. Then you'll see the Fed and everybody else in the world, central banks, geniuses around the world, will try to do the trick again with the QE kind of thing or whatever, similar kind of thing. And then you're going to see a stagflation set off. And that's why it's going to be much more prolonged and a much more severe crisis in terms for the consumers. So helping a few banks, merging them up and all that, yeah, they will do a lot of that. Will it solve the crisis? No, it will not.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening. Okay, thanks for explaining that. Yeah, it's going to be interesting to see. So if we sort of take a step back and look at, I guess, the current bull run, it sounds like you're sort of putting your money into the most speculative assets possible for, I'm sure you've diversified as well, but high exposure to speculative assets to take advantage of this run up in the near term.
Yeah,
Is that
absolutely.
correct?
Yeah. I mean, there's no need to, sit on the sidelines when everybody is throwing money after speculative things, as long as you know when to get out. And that is unfortunately the case around this, and you start to see that now. You start to see all the FOMO coming in, and you start to see projections into 25 and 26 and 27 on various cryptos and various assets and stocks and all that. And I just don't see it. So I'm getting my money out later this year, for sure. And I will be observing the economy. I will be observing the levels that I have in the markets. And as I said, if you go back in my tweets also on Twitter, you'll see that I said actually when we start to get when bears are becoming bulls, and I'll be shouted at in the market on Twitter that I'm wrong in terms of the direction. Well, that's the time to get out. We're not there yet, but we will get there, and it's because I will be right into the top of some of this the crazy cycle that I think we could see on altcoins and on crypto here in general, and yeah, also in U.S. stocks, I will say, because I think actually if you look at the foreign markets, you could see some top that is very close by or actually maybe in already, and so I think the rotation for some of these markets into the U.S. will also help propel the more riskier side of the market into the stratosphere. I mean, I think it's going to be a very nice couple of months here from now on. It's already been that for me. I'm not complaining, and I think it's going to be even better for the next 4 months or so into the Q3. But knowing when to get out, and unfortunately, a lot more people will lose money in the crypto cycle than far more people will lose money in the crypto run up and in risk asset run up than will earn money. And that is unfortunate, but that's because of the FOMO. That's because people do not like the guy who bears the bad news. So I understand that, and that's why I probably will hear more of that. I don't understand markets, that I don't understand that crypto will be the future, and if the dollar is going to the dollar is going to disappear or whatever, and all these things. I think people will be FOMO'd into it, and that's unfortunate.
Yeah, you've mentioned 6,100 and 6,200 for the S&P. Do you have any, I guess, price targets for certain cryptos as well?
Yeah, Bitcoin, as I have said for a long time, 110,000, 115,000, that range. That will be the top as I see it. I don't think anything will change that. I think we have a strong move going on from where we are right now. I think Ethereum will outperform Bitcoin, so I think Ethereum will move to around 7,700, 800, around that level, and then I think some of the small altcoins will outperform Ethereum. So you're going to see Solana even outperforming Ethereum. You see Jasmy that I'm in will outperform some of these because you have that normal rotation. First, Bitcoin pulls up, then Ethereum comes, and then you have the rest of them, the rest of the pack. But as we get more and more speculative, it'll be larger moves, but it will also be more a shorter time frame that we got to move into it. So yeah, this is I think it'll be a fantastic few months for those who are long, but it's about understanding when to get out and understanding that there will be an end to it.
Yep, great point. And then we've seen quite a lot of speculation in GME recently, and sort of other similar, I guess, companies which people love to speculate on. Do you see this sort of just being a part of this trend, or is this completely different?
That's it. There you have it. I mean, there you have it. It's exactly what you said. It's speculation. It's speculation about then you'll see this time the retail sales people, the retail people will actually make sure to bust people that are going short whatever kind of stock it is, and you have all these talks. What it's really about is about liquidity. When liquidity starts to flow into the market, and people believe that it's safe to be in the water because they don't understand that a recession is coming, people will be investing into all sorts of things, and we have a unsound financial system at this point here where too much money is circulating the system, and it's been for too easy for too long. The party has been going on for too long, and this time around again, we're going to see this extreme FOMO and euphoria, and and GME is one of them, and there will be others, and there will be a lot of people that will win some money or earn money on that, but they'll also lose a lot if they do not get out. Again, it's about knowing when to get out. You can ride the bull, and you just need when to stop to jump off, because you do not want to be in when this stops, and the recession. And then people say, yeah, but first of all, the recession, how bad will it be? And maybe it's just in the future. No, it's going to be really, really bad. And I don't even want to express my targets for, let's just say, something like Bitcoin at this point here, simply because people will think it's unrealistic and just laugh at when I say that. So I'll just say that you should be aware that things that do not have a value, that you something that you can actually yield, where there will be a yield from in a time of liquidity crisis, will be sold off. And that goes for gold, that goes for Bitcoin, that goes for crypto especially, and it goes for all, also speculative as stocks, small caps and the likes, that are not really yielding anything. So it is a difficult time to navigate this, and again, the blow off top is going to be euphoric, but also pull a lot of people in.
Yeah, as it always does. So once you sort of the indicator comes up and you decide to sort of liquidate your long trade, will you look to sort of go straight short, or how will you look to position yourself after that?
There will be many ways. There will be many ways to do that. There can be, of course, there can be a short play. There can be play with. I think I'll focus on the dollar, because I think there will be a severe liquidity crisis, and I think I can kind of read that better. I think it'll be less volatile. I think there will be a lot of volatility as well, also because when things start to get going with all the exposures and everything out there, and people will be shorting it and getting out and in and all that. So that part of the journey I will probably be more careful about because of the volatility. I may have an option play also that I could I would set up. I think there'll be many ways of playing this, but the main part of this will be for me to be exposed to the dollar versus other currencies, because I think there's going to be a liquidity crisis. The dollar is going to rally strongly into the recession. And again, now timing, when we look at this, I think the dollar is around 104 right now. Um, I think the dollar is going to drop to around 93, 95 before we see what I'm talking about here. So we see that decline, we see the blow off top into the dollar there, and then you're going to see a strong move up in the dollar. And at that point, there's a lot of, treasuries obviously would be fantastic, also US treasuries, and also German bunds and the likes could also be interesting, but it's about deflationary prone assets that you want to be exposed to in that. But my game will probably be around the dollar, versus some other currencies, and a lot of, also treasuries. I also hold those.
Okay, great. A lot of people have been talking about precious metals recently, and they've sort of at all-time highs. Do you see them, I guess, continuing? They're seen as a safe haven, or a lot of people might think that maybe, as you said, people just need liquidity, so they're going to actually have to sell their potential gold to get that liquidity. What's your thoughts on that?
Yeah, now you said precious metals are at all-time highs, but they are actually not. Gold is at an all-time, or have been at an all-time high. But if you look at palladium, it's not. If you look at platinum, it's not. If you look at silver, it's not. If you look at the gold miners, silver miners, they're not. So one could ask, who is the odd man out here? The odd, precious metal out. And I think gold is. There's various, in a technical world, there's various correctional moves. Some of them actually move to higher highs before they move lower. I still see that into a liquidity crisis that I'm talking about here, like what we saw also in the financial crisis, that you're not going to gain by having, any gold positions, because again, people do not you got to have gold because it's a crisis. Well, you got to have gold at the moment when the crisis peaks in the deflationary part, when the Fed comes in, and then you can have gold. But until then, you do not hold gold. So yes, have gold moved up? Yes. Did I see that? No. But do I think it's going to crash into the financial into the to the liquidity crisis? Yes, I do. So you do not want to hold it in this phase here. But when you get to the point where the Fed steps in, and they step in for real, because not just about the rate cuts or whatever, that's not what I'm talking about, because that's not going to stop the deflationary deflationary outcome. But when they step in for real, that's the moment when you want to go long precious metals. But that level for where you can step in is much lower than where we are today. And actually, palladium, platinum, silver, and so on have been telling us that, because normally in a real bull phase of the gold and silver and all that, you will see those leading, and they have not. And we've seen a lot of talk about it, but it's not materialized. So people talking about this, yeah, but gold now, Henrik, you're wrong because you said this, and that. Well, let's see about it. Let's see what happens to gold into this deflationary phase here, into the liquidity phase, because people that you need to hold liquidity, you need to hold dollars, and you need to hold, be able to pay off your debt, and all these things. And that's not when you don't want to hold gold at that point. So gold will have its time, and I am very, very bullish gold and silver and platinum and palladium and all that when we get into the right part of the crisis. But that's not the first part of the crisis.
Okay, yeah, that's a good point, as you said. Sorry, gold's at all-time highs and the others aren't. But let's go past the crisis. As you said, it's probably going to be very volatile. We're going to see large drawdowns. Do you think we're just going to see, I guess, after that, we're going to see a repeat of what we saw after 2008 with an extremely long bull market and lots of, positivities for, we don't know how long, but for a period of time, or how do you see that working? Or is it that too far ahead to consider?
No, it's okay, but of course things are more speculative. But of course I've made myself, made some, I have some ideas on what I think can happen, when we go past the deflationary part and the stagflationary part. But I think that what people do not understand and remember here is really what's going on through a stagflation. If I'm right, when the Fed jumps in for real during the deflationary bust, you'll probably see that the real economy will not really bounce to begin with. So you'll not see the employment will not come up for some time. And that is a problem, because that's why they jump in. They want to make sure that people get a job again, and you got the positive spiral going up. what you'll probably see is that will offset a stagflationary impulse here, and that is something that is difficult for the central planners or the central bankers, you can call them, to navigate in, because you cannot just cut rates or hike rates and to get what you want to to solve the stagflation. So what do you do when interest rates are so when inflation is going up and rates are going up, and at the same time you're actually seeing the economy stalling? That's something we haven't seen really since the 1970s. And what you this time around, I think it's going to be really severe, because we have so many years of distortion in prices that is going to come to haunt us, and that we we thought that we could just print us out of this, and then everything would be fine. It's going to be something that, yeah, as I said, going to haunt us down the road here. So what will probably happen is that we will need to see some kind of monetary reset. I think they will have to introduce sound money again to the system, so to speak. I mean, if inflation runs up and you see people losing their jobs, and the thing is that you can get to a point where this can start to have the social contract to crumble, as a meaning that people start to lose their trust in government and in the society, and will start to actually say, oh, if this is the way things are, I mean, I'm losing my pension savings, I'm losing my job, and prices are moving up, and I'm living with my mom and dad, I'm 40 here, whatever. These kind of things are things that can put people in the street with pitchforks. So you will need, as not as central plan or central bankers, because they can't do anything about it, but the politicians will need to understand that this is something that they will actually need to step in, and will have to take have to understand that central bankers have they're now tried since 2008 and they failed, and now we will have to actually do something about the entire monetary system, which will come to a political perspective, political situation, and this is a much bigger thing than what we did after the 2008. After 2008, they started printing money. Hey, everything solved. What we do see is now, 16 years later, it only kicked the can. In the US, everything seemed fine, but if you look in a lot of the European market, a lot of the European markets are still way below the levels that we had in 2008. And if you look at the European banks, they do not look good at all. So you are not going to see something like 2008. They're going to try the same medicine, but that medicine is not going to work, and it's actually going to create another disease, stagflation, which will then be much more severe and will be much more hazardous, severe again for ordinary people, and that can be a problem for politicians. So this is going to be big, and it's going to be bigger than 2008, and that's why I'm also saying it's going to be the biggest recession we have seen, if you look at the long time frame of it, and the decline in the market, and so on, since the depression in the 1920s. So it's going to be bad.
Henrik, on that note, thanks so much for coming on the podcast today. I really appreciate it. My last question is, what is one message you want people to take away from our conversation?
Well, I think it's about think. I mean, that is what my granddad already said to me. He said, Henrik, use this one. Come on, think. Do not just follow. And I think this is about, thinking this time around. If you see the same kind of indicators that we had before the financial crisis, and before the financial crisis, we were told everything is fine, we got it all sorted, it's all good, and you can just, we will make sure that the economy lands safely. Look at the things, the indicators, look at where the economy stands through, and just, you can follow me then for doing that, or whomever, but just look at it and then say by yourself, is this time really different? Do you really think that they have, discovered something? We're talking about the people that said that the recession would not come, and just before we stood in a recession, or they said that the recession would be postponed for not see that for many years, and then we were actually in the middle of it. I mean, do we really believe that these people have their they've seen something that we cannot see? So think, use your own mind, brains, and look at the indicators, look at the economy, and then see for yourself what you think, and then protect yourself in the right way, and understand that there will be whipsaw effects, whipsaw situations where one day this will be the right thing to do, but the next day it will actually not be the right thing to do. So this will be very difficult for a lot of people. But think.
Great message, Henrik. Thanks so much for your time today. Really appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
This place will be to find me on my Twitter profile, Henrik at Henrik Zeberg, and yeah, well, there will be links to wherever you can find me also, and other interviews and what else I've been in.
Great. I'll put that in the description below. But thanks again for your time.
Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.